Can I claim crypto losses on taxes in Australia? Welcome to this educational series, Unraveling Crypto Tax in Australia by Crypto Tax Calculator. I'm Patrick, and I'm here to break down the complexities of crypto taxes in Australia so you can file with confidence this tax season. In this series, we're covering the simple stuff like capital gains tax and income tax, as well as diving deep into complex on-chain transactions like staking, DeFi, and NFT trading. If you've incurred losses and meet the criteria for claimable losses, you should absolutely claim them on your tax return. Let's look at capital losses. These are the losses that occur when you sell a capital gains tax or CGT asset for less than what you bought it for. Similar to capital gains, capital losses can only come into play if a CGT event has occurred. It's quite simple to calculate your capital loss if you have incurred one. If the original purchase price is higher than the selling price, what we call the capital proceeds, you can use this approach. You deduct the capital proceeds from the original purchase price, also known as a reduced cost base. So capital loss equals reduced cost base minus capital proceeds. For instance, you buy crypto for $15,000 and later you sell it for $5,000. Your capital loss in this case is $10,000. There's also something crucial to note about capital losses. They can only offset capital gains within the current income year, and any unused losses are rolled over into future years. For example, if you have a capital loss from crypto assets, but a capital gain from selling your shares during the same income year, you can use your crypto losses to reduce your capital gains. However, bear in mind that capital losses can't offset capital gains from previous financial years, and they can't be used to reduce taxable income like your salary or wages. Now, if your capital losses for an income year are greater than your capital gains, you'll likely have what we call a net capital loss. This leftover loss can be carried forward to offset capital gains in future income years. There's one more important point to keep in mind. The Australian Tax Office, or ATO, has warned taxpayers not to engage in what they call wash sales. These are when you sell off crypto assets just before the end of the financial year, then reacquire the same or very similar assets soon after. This might sound like a clever strategy to increase your losses and reduce actual or expected gains without changing your overall exposure to the asset. However, the ATO views wash sales as a form of tax avoidance and can deny these capital losses from these transactions. Keep watching Crypto Tax Calculator's series, Unraveling Crypto Taxes in Australia, to learn more about how crypto is taxed so you can file with confidence this tax season. In the next video, we'll answer, can I legally avoid crypto taxes in Australia?